welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Life doesn't move fast or slow. It just waits for you to make plans and then adjusts accordingly. Experience is just hindsight with a resume. This meeting could have been an email. But then how would we justify the calendar? The phrase, circle back, exists solely to postpone decisions while sounding athletic. The long term is where forecasts go to retire.
For once, investors agree, and that alone should worry you. A Deutsche Bank survey shows AI and tech valuations towering over every other 2026 risk. Not inflation, not geopolitics, not China, just prices running far ahead of fundamentals. The runners-up aren't very comforting either. Political pressure on the Fed and stress in private credit, meaning policy credibility and hidden leverage are both under scrutiny. When markets agree this loudly on a single risk, history says volatility isn't far behind. Crowded trades don't unwind politely. If this chart feels dizzying, that's the point. Big tech's AI boom isn't a straight supply chain, it's a financial carousel. Microsoft funds OpenAI. OpenAI buys clouds and chips. Nvidia sells the chips, invests back into OpenAI, and everyone books growth. Valuations rise, capex explodes, and the same dollars keep changing hands. It works beautifully until demand slows or margins blink. Then the loop stops spinning, and suddenly everyone discovers that they are each other's biggest customer. As John Galbraith put it, the only function of economic forecasting is to make astrology look respectable. India's trade math finally behaved in November. The merchandise trade deficit slid to a 5-month low, helped by a sharp rebound in exports, especially to the US, up 22% year on year, tariffs notwithstanding. The quiet hero here is the services. A steadily rising services surplus is cushioning the current account, doing the heavy lifting while goods trade stays volatile. Bottom line, this isn't a boom, it's damage control done quite well. Fewer external pressure points, a little breathing room for the rupee, and no panic buttons for policymakers. In 1990, India and China were neck to neck in services. India even had a slight lead. Fast forward to today, China's services economy is 5 times larger, and in manufacturing the gap is even louder, 9 times. This isn't about India failing at services, it actually did quite well. It's about China scaling everything, everywhere, all at once. Factories, logistics, capital and demand. Services follow industry, they don't replace it. The lesson is uncomfortable but clear. Specialization without scale wins praise and not power. The headline says Magnificent 7, the table says concentration risk. Yes, a few names are up big, but look closer. Most of the Mag 7 rank deep in the pack on both the S&P 500 and the Nasdaq. The indices are up, the average stock not so much. This is a market held together by weights and not breadth. A handful of giants are doing the heavy lifting, while hundreds quietly underperform. Great for index returns, awkward for stock pickers. When leadership narrows this much, markets don't crash, they lose balance. From 2020 to 2025, India's biggest wealth creators were in momentum trades. They were boring winners done well. Banks, infra, telecom, and steady compounders dominate the list. Not many fads, plenty of cash flows. Look under the hood and the pattern is clear. ROEs improved, profits scaled, and valuations followed, and not the other way around. This wasn't multiple expansion cosplay, it was earnings doing the heavy lifting. The markets did not just reward excitement, it rewarded execution. As Peter Lynch very nicely put it, know what you own and know why you own it. This map tells a very simple story. India's exports are highly concentrated. Gujarat and Maharashtra alone carry a huge share, with Karnataka and Tamil Nadu close behind. A handful of states power the country's trade engine, the rest are passengers for now. The mix matters too. Goods-heavy states dominate volumes, while services-driven states punch above their weight in value. That's efficient but also fragile. Regional shocks travel fast when so much depends on so few. Diversifying exports isn't about fairness, it's also about resilience. Here's the irony of this cycle. Emerging markets look safer because rich countries look messier. As institutional quality erodes across the G10, think political pressure on central banks, investors are reassessing old assumptions. Stability is no longer taken for granted where it used to be. That's why flows into EM stocks and bonds have stayed strong. It's not love for risk, it's relative credibility. When rulebooks blur at the top, countries with cleaner frameworks suddenly look investable. Trump isn't automatically bullish or bearish for EM, he just reshuffles the pecking order.